Hey, how are you? I'm Duncan McPherson, and welcome back to my channel. Today is the final in my four-part series, where I'll be providing you a partial list of tax traps to be aware of as you expand into Canada. So listen up, because it is quite easy for you to unwittingly get caught with interest or a penalty up here when you don't have to. And as always, before we get rolling, don't forget to hit that subscribe button and notification bell if you want more tips on how to survive and thrive in the Canadian tax system as a U.S. business or a U.S. individual. Or if you'd rather cut through all the nonsense and get expert help right now, you can contact me directly through themactax.com and let's get chatting. So in today's video, I'm going to tell you about a few nastier landmines that CRA may use once you're carrying on business up here. The first which you need to know about are the Canadian transfer pricing rules. As a quick note, they're very similar to the US transfer pricing rules. But this is where things do get a little bit interesting, so listen up. And just in case you're not familiar with the term transfer pricing, and forgive me for reading this off of my cheat sheet, transfer pricing refers to your intercompany loans and your intercompany charges between your related companies, where your related companies are in different countries, in our case, Canada and the United States. But here's what I want you to keep in mind. In order for the transfer pricing penalties to apply, your transfer pricing error must have reduced your income by at least 10% or $5 million, whichever is lower. And if you're caught, the penalty is quite substantial. It's 10% of your transfer pricing error. So if you overpaid an expense by $100,000, your penalty would be $10,000. This would be in addition to other interest and penalties that could be assessed against you under the Income Tax Act. Note, the transfer pricing penalty can always be avoided where you used reasonable due diligence in determining your transfer price. Ergo, maintaining contemporaneous documentation. And I really wish they'd found shorter term. If you're not familiar with the term contemporaneous documentation, this is the documentation that proves your transfer price. Note, in both Canada and the United States, the IRS and the CRA do provide regulations on what constitutes appropriate contemporaneous documentation. When CRA asks you for your contemporaneous documentation, you better have it ready, or the transfer pricing penalties will apply to you. And I should tell you, in both Canada and the United States, the timing of when you have to have your contemporaneous documentation ready is codified in both countries. So you can't just run out and get it once they ask for it. But that's all I'm going to say about contemporaneous documentation today, because it warrants its own video. If you are unfamiliar with contemporaneous documentation, you better call me right now at themactax.com. Got it? Good. Now, next on the checklist for things for you to keep in mind is the Income Tax Act, Section 67. Section 67 requires that all your expenses must be reasonable in the circumstances. I know that sounds simple, but there's a domino effect here if Section 67 applies. So listen on and listen up for the dominoes. And let me tell you, Section 67 can get you in a lot of trouble with your transfer pricing. For example, if you try shifting profits from your Canadian subsidiary to your U.S. parent company simply by charging a blanket management fee, look out. Because if CRA finds your management fee unreasonable pursuant to Section 67, CRA will, number one, recharacterize your management fee as a dividend. Number two, make you pay withholding tax on the dividend. Number three, make you pay interest on the late withholding tax on the dividend. And number four, possibly subject you to transfer pricing penalties. There's your domino effect. Now, where very little effort was put forth on your part to determine what economically the management fee actually was, CRA is likely to assess you with gross negligence penalties as well. But again, you can avoid the gross negligence penalty and the transfer pricing penalty just by preparing appropriate and correct contemporaneous documentation. So please do not mess around with management fees. They are a red flag up here. Instead, just, number one, determine what you are doing in the USA for your Canadian subsidiary. Number two, determine what the work you did in the United States is worth to your Canadian subsidiary. Number three, get your contemporaneous documentation in place to prove your management fee. And number four, keep good books and records to show what work you did and that it was accounted for accurately. This is a must for you to do with management fees. Because remember again, it is way too easy for the CRA to stick their algorithm on you and ask you for the contemporaneous documentation for your management fee without the algorithm ever telling a human they're doing it. Another situation where CRA's reasonability weapon comes up is where you, the US parent, charged an unreasonable amount of interest to your loans to your Canadian subsidiary. Again, Again, in these cases, your overcharged interest would be recharacterized as a dividend to your parent company, and a 5% withholding tax would apply. I remind you here that interest expense is subject to zero withholding under the Canada-US tax treaty. In addition, if the interest you charge your Canadian subsidiary is considered usurious, you'll be charged gross negligence penalties. But this should be obvious to you. Now let me move on to something a little more common. In fact, way too common. So you should not only be mindful to not be overcharging expenses, but be very mindful of your bookkeeping whenever you are booking intercompany expenses. Because often I see companies like yours aimlessly running transactions through their intercompany accounts, where at the end of the year, they call the balance in the intercompany account a loan, which means CRA can come in, take a look at all the transactions in your intercompany account, and start asking questions on all the entries in this account, and there's probably hundreds of them. Think about it. Even if they're all legitimate, look at the paperwork you've created for yourself. And after going through this account, CRA is going to turn to you and say, how is your intercompany dumping account a loan? Think about how clumsy you're going to look and how vulnerable you will be. So don't just have a transfer pricing strategy, have a bookkeeping strategy as well of how your intercompany transactions are going to be accounted for, and reconcile all your intercompany accounts quarterly, if not monthly, before the information gets too old. If you have to do this and you have to fight CRA, you're fighting with your hands tied behind your back. I'll tell you that much right now. Your high-end shyster and bean counter fees will go parabolic during this fight. Be aware. It is very easy to find yourself in the realm of gross negligence penalties, where your intercompany charges are blatantly unsubstantiated and recklessly booked. So please don't fuck with this stuff. It is way too easy for the algorithm to come after you and nail you. Scared yet? Well, guess what? There is more. Way more for you to worry about with transfer pricing. For starters, it no longer ends with you keeping good books and records. Because from here on out, this is just the beginning for you. Because under the latest OECD guidelines, and I'm going to read this one off a cheat sheet. I apologize for that. Because under the latest OECD guidelines, the CRA, in addition to everything discussed so far, will now make transfer pricing adjustments if they feel you have not booked enough profits in Canada, if they feel the risks and rewards economically occurred in Canada and not in the country you cleverly booked the profits. But call me about this one, because this concept is way too new to be putting in a video. And if you don't hate me yet, I got one more for you. Next in the CRA arsenal of aggravation is the penalties if you file your Form T1134 or Form T106 late. These forms are equivalent to your US Forms 5471 and Form 5472. In Canada, these two forms are filed separately from your corporate tax return. They have different due dates and they can be filed electronically. As an aside, if the numbers on these forms do not agree with your financial statements and your corporate tax return, the CRA algorithm is going to write you a very polite letter and ask you for more information. Now back to your forms. The late filing penalty for Form T106 and T1134 is $25 a day to a maximum of 100 days or 2,500 Canadian dollars. So you maxed out at 2,500 Canadian dollars plus interest, which is peanuts compared to the US $25,000 penalty you get in the US for the same forms. You see how nice we Canadians are? We're not trying to rip you off as certain individuals would have you believe. All right, my friends, that's it for today. So if you already didn't have enough problems in your life with tariffs and the IRS, now you have a list of crazy shit to deal with as you expand into Canada and beyond. But as always, remember, many of your tax problems can be avoided with a little planning and quality bookkeeping. But with today's stuff, this is just the beginning. You must have, number one, a transfer pricing strategy. Number two, a contemporaneous documentation strategy. And number three, a bookkeeping strategy. And it must all be kept up to date and reviewed by an expert. If it's not up to date and you go to war, it will be expensive. And you'll be probably paying your accountants and lawyers to negotiate a surrender, not a win. But let's be realistic. If you watch this far, you're probably concerned about all this stuff, right? So if this is you, don't forget you can always contact me at themactax.com and I'll get you through this maze of bureaucracy. And of course, as always, don't forget to subscribe for more tax savings tips. Until next time, stay sharp, stay compliant, and please stay out of tax trouble. I'll see you on the next video.